Hello and welcome to Pro Trader Strategies Market Commentary for Monday, March the 26th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please take a moment to look over this disclaimer as it talks about there is substantial risk to losing your money when trading. This also says that I can't give you investment advice because I don't know your risk parameters. I don't know what's in your portfolio. So therefore, what I'm doing could be counterintuitive to you, what you're already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. We got nothing really across the pond. As it's a Monday usually a pretty quiet day, but here in the United States, we are going to see a plethora of Fed governors speaking. Remember, last week was the FOMC, which is the day that they moved rates. Well, 2 weeks prior to that, they're not allowed to talk about any policy. And after, they can talk about whatever they want. So as soon as it's over, usually the next week, they all come out and start talking their position. So today we have Dudley, Mester, and Quarles speaking. Bortles, I think, is later on this week, and a couple other ones. So just keep in mind that there's going to probably be a lot of policy talk this week, especially in the news. But as for economic data today, we don't really have anything. All right, on to the overall markets. We've got crude oil coming off just slightly. After the settlement Friday, it looked like we were kind of getting back into this trend channel and was looking for it to kind of start to rally. But today, we're seeing a little bit of pullback. Nothing really out there in the news necessarily. I think it's just really at a flexion point where we're starting to get maybe a little bit over priced or a little frothy for the type of conditions we're really seeing in the overall economic picture. We do have still loads and loads of crude oil inventory, gasoline, and we continue to increase rig counts, which is going to generate more supply. So all of those things being said, I don't necessarily believe we're seeing massive demand, and at some point it does have to start to roll over a little bit. We might see a bit of a correction here in crude oil, but I think it's going to stay very tight to the 60 area. So that's going to be the over-under. 68 might get a little extended to the upside, whereas starting to get into the 50s, it's going to be a little bit cheap, I think. So just keep that in mind going forward for crude oil futures. I don't really have anything on in that market, so I'm not touting it either direction at this point. Anyway, Putin loves his gold. It's still driving higher, up another $4.50. It's unrelented, other than on Thursday we saw a little bit of profit taking going on, but the next 2 days, Friday and today, you can see that the market is continuing to leap towards the 13,765 is probably the high. So somewhere right around there. It looks like it's got that line in the sand on its marker to go up and print. I don't really see it. I think the overall economy is doing pretty good. Usually you see this as a flight to safety. I don't think that it's the right time. It's really just, people, Putin, I think, buying up the gold. And the rest of the market sees that he's doing that and are chasing it, helping push that up. Bitcoin futures having another bad day today. This market is very bearish right now. I think it's definitely looking to go down there and test that $5,880. So that, this value area high is very important to the bulls right now. They would like to at least not go down there and break through that for a settlement. Maybe a test would be okay, and then a bounce to create somewhat of a bottom. But in order for it to really make it look like it's going to be creating a bottom, I think it needs to go down there to test that and get like a tweezer bottom for the bulls to start really buying into this product. VIX still elevated right now, as we're seeing pretty massive moves in the Dow and stuff like that. Dow was up 450 points 1 minute, down only up 200 another minute, so a 200-point move in a matter of a few candles, if you will. So the market has stayed volatile. Markets moving up will have a tendency to cause the VIX come off, is what we're seeing today, but still staying at elevated levels because there is no serious discernible direction to this market at this point. So they're going to keep that VIX a little bit elevated during that that time. And another reason is if we look at the Dow Jones Industrial Average up at 400 points right now, this is what I was talking about just a few minutes ago. It was only up about 200 points. So we're getting these big swings in the Dow right now, up 440 points right now. But if we look at this doji compared to this doji, that is a typical inside day. We haven't busted out above the wicks or below the wick. And that on Friday, that 50 Fibonacci held like a champ, came down and just tagged it and stayed there. We basically finished on the lows of the day. Today you can see we opened up higher and are continuing to move up. But having said that, today's candle inside of yesterday's candle and basically all of the markets. So very inside day. It doesn't matter if we had that massive move and we have a big move today, as long as it's inside of that previous day's candle, that is considered an inside day, which is what we're seeing here also in the Nasdaq, albeit up 90. We are still an inside day. We've been talking about these Fibonacci extensions here, or projections, if you will. Friday's coming down to test the value area high was a very important support resistance level. So we're going to probably need to keep that line or that mark right there at 65.15 in the Nasdaq as a low. That is going to act more solidly than this line did at this point. So, one of the things we could do is just cover that one up and draw another line in here for the lows for the Nasdaq, because I think that that's the more important number than that number up here that we saw as the low. It is going to act as resistance on the way up, but we're kind of looking for this stop on the downside, right? This is what I'm trying to talk about right there. All right, then in the mini S&P is another situation where it is another inside day. That 50 Fibonacci level didn't hold as strong as we've seen in some of the other markets, but as you can see, the 50 Fibonacci that I'm talking about is for the broader market move, but this 200-day moving average on Friday, when we came down and touched on that, that's the only market that really didn't finish on the lows of the day between the Nasdaq and the Dow, as we got a bounce off that 200-day moving average. But again, just an inside day. That is no way to say that we have broken this bearish trend, because we are now in correction territory for these equity markets, and this inside day candle is not really going to hold a whole lot of weight, to be quite honest, on a directional change or getting out of bearish territory, if you will. But E-mini S&P is doing quite well, up about 30 points on the day. This is what we're talking about. Friday's close, as you can see, it was very near the lows of the day. Overnight inventory is actually long coming into the open of the day, but they flushed them out, as you can see right here. As soon as the market opened, we came down and retested that 50 Fibonacci level and are currently middle of the range, if you will. And you can see with even the market profile, we have an inside day where the value area low is lined up with the previous day's value area low, value area high, well inside of that move. So that is another indication of an inside day, a little bit more descriptive with the market profile, as you can see here. All right, let's get on to a couple of things that I'm looking at here. Now on Friday, late in the day, with Tesla coming off, all of this bearish news coming out. If you remember, I'm long a 2-year put in Tesla, and I paid for that 2-year put already by trading around it. Now, if you remember, after I bought that 2-year put, I was like, hey, you know what? I'm going to sell some puts here just slightly higher. So I'm long the 150 puts in January of 2020. I sold some April 200 puts, because I was starting to feel like maybe it was a little bit overdone. There might be a little bit of a correction here. So I just wanted to collect some more premium with the implied volatility at seriously high elevated levels. As you can see, it's the highest area of implied volatility that we've seen over the past 52 weeks, even superseding the big move down that we saw in the broader market. So now 100% IV, no earnings in this session. So I went in there and sold some puts just in case there was a bit of a bounce. Applied volatility didn't go in my direction. It actually started increasing. And there is a lot of skew to the put side in Tesla. Everybody is very bearish, or very worried about the downside in Tesla. So those 200 puts that I sold just really aren't decaying very much. And I'm getting the directional move that's not really in my favor. So I decided on Friday I was going to turn those puts into a strangle so I can be a little bit more mechanical, have a little bit more wiggle room, if you will. If anything's to go wrong here, I added some calls to those puts and created a strangle. So on Friday, late in the day, right before the close, I went into that same April contract and sold the 360 calls in there, and I collected $1.16 for it. Right now, they're trading around 70 cents. So that move to the downside is being offset, isn't necessarily being offset by the increase in volatility, is what I should say. So those calls are actually doing a lot better than my puts on the strangle aspect of it. So I'm actually looking to just leg out of this. Since I legged into it, I'm going to be looking to leg out of it. Right now I'm working those Tesla calls for like a 65-cent bid. I think it's trading around 71 right now. But along those lines of my rules, I look to collect 50% of my max profit, right? Well, I'm already at 40% of my max profit, and I've only been in this trade for 2 days. So it doesn't really make a lot of sense for me to risk that other 10 cents, if you will, to get to 50% of my max profit. I mean, it happens so fast, you just can't kick a gift horse in the mouth. So that's not what I want to do. So I'm looking to get out of that today, working a 65-cent bid, but I am going to be looking to cover that relatively soon today, most likely. And then the other one is in Facebook, getting my directional move. It's getting a bit of a bounce, looked a lot better today, and that's what kind of made me start to decide I probably need to get a little bit more diligent with this, because if this rallies much further, that's going to look like a very solid bottom with this big move down, and then we got like a hangman doji or something like that, a very massive hangman doji at the bottom. That would really, to me, signal that we are very close to a bottom and probably get a little bit of a bounce. So I'm looking to cover my short calls in Facebook, and they are the April 185 calls in there. So working a bid right now for around 20 cents, which is a little bit over 50% of my max profit on that. Right now, 30 cents is around 32 cents is right around 50% of my max profit. So I'm better than 50% of my max profit on this, just letting it squeeze out just a little bit more for just to wait to the end of the day. If we start getting up further, I'm going to probably cover that. If it starts finishing off towards the lows of the day and look like it's going to continue, then I'm going to maybe stick in that for a couple more days. And then that's about it for today. I haven't added anything. I haven't done anything in my IRA. Those are just a couple of the orders that I'm working, and I haven't added anything so far. So just kind of keeping my eyes out, leaving a little bit of powder for Lululemon. It's going to be one of our last trades that we get to do for earnings. It's really starting to wind down now, and that comes out tomorrow after the close. So, and I'm pretty close to using all of my capital right now. So I need to either cover something or do some moves back and forth, which is another reason why I'm trying to cover a couple of those trades, free up some margin for some trades later on. All right, that's all I got for you guys today. Friday's webinar is going to be on the Iron Condor, you guys. It is one of the more popular strategies out there for trading options, and we've gone from the intermediate side where we're starting to get a little bit more advanced. Well, part of the advance in this cycle is that we are increasing our risk parameter, our risk profile, in a sense, by collecting a credit rather than paying a debit, which is more widely seen as less risky. I'm going to show you why it is not a higher risk strategy necessarily. It's just what the street kind of tries to tell you, because they don't really understand options. And I'm going to go through all of those reasons why it's actually a lower risk trade, in a sense, because your probabilities are higher. It's not necessarily the thought that you're selling for a credit and that is your risk, that you're risking more. So I'll go through all of those rules on Friday's webinar. I don't want to get into it too long right now, but please like or comment at the bottom of this video. I love the feedback. Even if you don't like it, tell me why you don't like it. Maybe we can make some adjustments here to make it fit what you're really looking at in trading. All right, so go to protraderstrategies.com, sign up for the webinar, and like or comment at the bottom here, and I will be sure to get back to you. All right, so if you can't take that, take it easy.